There's a date you need to remember, January 1st, 2026. That's today. And as of this morning, something changed in the global silver market that hasn't changed in decades. Not a price, not a futures contract. Something more fundamental. The rules about who can move silver, where it can go, and who gets to decide. The new policy is now active. As of midnight Beijing time, any entity wanting to export refined silver from China requires government approval. Not automatic approval, not rubber stamp approval. Case-by-case discretionary approval from the Ministry of Commerce. And that ministry answers to the State Council, which answers to the party. Now let me start with what led us here. 41 million ounces. That's how much silver China imported in October of 2025 alone. For context, that's roughly 5% of global annual mine supply in a single month, flowing into one country. And they didn't slow down in November or December, they accelerated. And then, on December 15th, Beijing published a notice. Short, technical, the kind of document most people would scroll past. It reclassified silver as a dual-use material subject to export licensing. If you're not familiar with trade policy language, that might sound boring. It's not. As of today, the global silver supply chain operates under a completely different set of rules than it did yesterday. And the markets are already responding. Now, before we go further, let me establish what we're actually talking about. Silver is not like other commodities. It sits in a strange position. It's an industrial metal. It's used in photovoltaic cells for solar panels, in multi-layer ceramic capacitors for electronics, in brazing alloys for manufacturing, in antimicrobial coatings for medical devices. The Silver Institute estimates that industrial applications consume roughly 480 million ounces per year. That's more than half of total supply. But silver is also money, or at least it has monetary characteristics. Central banks don't hold it the way they hold gold, but private investors do. Coins, bars, exchange-traded products. In 2024, investment demand for silver was approximately 200 million ounces. So you have this material that is simultaneously a critical input for modern technology and a store of value during periods of monetary uncertainty. That dual nature is important because it means two completely different groups of buyers compete for the same finite supply. And that supply is not growing quickly. Global mine production has been relatively flat for the past 5 years. We're at roughly 830 million ounces annually. Some of that comes from primary silver mines. But most of it, around 70%, comes as a byproduct of mining other metals: lead, zinc, copper, gold. When companies dig for those metals, silver comes along, which means silver production doesn't respond quickly to price signals. Even if silver prices double, you can't just open a new silver mine overnight. You'd have to wait for base metal production to expand, and that takes years. Now let's talk about refining, because this is where China's leverage actually exists. Mining the ore is one thing. Turning that ore into refined, tradable silver is another, and a significant portion of global refining capacity is located in China. Estimates vary, but credible industry sources suggest China processes somewhere between 30 and 40% of the world as newly mined silver. That doesn't mean China mines all of that silver. It means the raw material is shipped to China, processed in Chinese facilities, and then re-exported as refined metal. Or at least, it used to be re-exported. As of today, that re-export now requires a license, and there's no indication yet that licenses are being granted freely. In fact, if you look at how China has managed similar restrictions on other materials, the pattern suggests licenses will be rare, slow, and conditional. Let's use rare earth elements as a reference point. In 2010, China controlled roughly 95% of global rare earth production. In September of that year, during a territorial dispute with Japan, China reportedly restricted rare earth exports to Japanese manufacturers. The restriction was never officially confirmed as policy, but Japanese companies experienced significant delays in shipments. Prices for certain rare earth oxides increased by several 100% over the following months. The lesson was clear. If you control processing, you control access. And if you control access to a material that has no easy substitute, you control the industries that depend on it. After 2010, the United States, Australia, and other countries invested heavily in developing rare earth processing outside China. More than a decade later, China's share of global rare earth refining has only dropped to around 85%. Building that infrastructure takes time, capital, and expertise. It is not a quick fix. Silver is different from rare earths in scale. Silver markets are larger, more liquid, and more globally distributed. But the principle is the same. If a significant portion of refining happens in one jurisdiction, and that jurisdiction decides to restrict outflows, the rest of the world has a problem. So what does this actually look like in practice starting today? Let's walk through a scenario based on how these systems typically function. Imagine you're a solar panel manufacturer in Germany. You need silver paste for your photovoltaic cells. You have a contract with a supplier who sources refined silver from a facility in China. Yesterday, that was straightforward. The refinery processes the material, ships it to your supplier, and you receive it on schedule. As of today, the refinery now needs to apply for an export license. The application process is not transparent. There's no published timeline. There's no guarantee of approval. Your supplier calls the refinery. The refinery says they're waiting for guidance from the Ministry of Commerce. Your production schedule is now at risk. You have contracts with customers. You have penalty clauses for late delivery. So you start looking for alternative sources. You call suppliers in Switzerland. They're facing the same uncertainty. Their refineries also relied on Chinese processing for a portion of their throughput. You call suppliers in the United States. They have material, but at a significant premium over the price you were quoted 2 months ago. You ask why. They explain that everyone else is also trying to source outside China, and available supply is being rationed. You agree to pay the premium because you have no choice. Your costs just increased by 20%, and you still don't have a guaranteed delivery date. This is not speculation. This is how supply chain disruptions manifest in real-world industrial processes. And it's already happening in other sectors that depend on Chinese processing. Graphite for battery anodes, gallium for semiconductors, bismuth for pharmaceuticals. The pattern repeats. Now let's talk about pricing, because this is where things got technically interesting over the past few weeks. Silver trades on multiple exchanges. The largest by volume is COMEX in New York. Then you have the London over-the-counter market coordinated by the LBMA, and you have the Shanghai Futures Exchange. Under normal conditions, prices on these exchanges stay relatively aligned because of arbitrage. If silver is cheaper in New York than London, traders buy in New York and sell in London until the price difference disappears. But starting in late December, something unusual happened. The Shanghai silver price started trading at a persistent premium over COMEX, not a small premium. We're talking about $4 to $6 per ounce at times. For context, the typical spread between these markets is usually less than $1. Arbitrage should eliminate that gap almost immediately, but it didn't. The gap persisted for days leading up to today. Why? Because arbitrage requires the physical movement of metal. You need to be able to buy silver in one location, transport it to another location, and sell it there. But if export restrictions are creating friction in that process, arbitrage breaks down. The Shanghai Premium suggested that physical silver inside China was becoming more valuable than paper silver traded on Western exchanges. It suggested that getting metal out of China was becoming harder even before the official implementation date. And here's the critical point. COMEX prices are discovered through futures contracts. The vast majority of those contracts are cash settled. They never result in physical delivery. The London OTC market is similar. These are paper markets. They measure price exposure, not availability. Shanghai, by contrast, reflects actual physical metal that can be delivered to Chinese industrial users. When those two pricing mechanisms diverge significantly, it tells you something about underlying physical supply. Let me show you another data point. COMEX registered silver inventories. Registered means silver that is available for delivery against futures contracts. As of late December 2025, registered inventories were approximately 240 million ounces. That sounds like a lot. But consider that global industrial demand alone is around 480 million ounces per year. The entire COMEX registered inventory represents roughly 6 months of industrial consumption. And only a fraction of that inventory is actually available at any given time, because much of it is already committed or in transit. Now, does this mean COMEX is about to run out of silver? No, because as I said, most contracts are cash settled. The system is designed to function as a pricing mechanism, not a delivery mechanism. But it does mean that if a significant number of market participants suddenly decided they wanted physical delivery instead of cash settlement, the system would face stress. And historically, when that kind of stress develops, exchanges have tools to manage it. They can raise margin requirements, they can impose position limits, they can restrict deliveries, they can even halt trading if necessary. The London Metal Exchange did exactly this with nickel in March 2022. Nickel prices spiked dramatically due to a short squeeze. The exchange suspended trading, canceled trades that had already been executed, and changed the rules retroactively. Participants who were on the profitable side of the trade had their gains erased. The exchange prioritized systemic stability over individual contract rights. This is not conspiracy. This is how exchanges manage existential threats to their clearing systems. Could something similar happen in silver? The structure is different. The circumstances are different. But the underlying principle is the same. Exchanges exist to facilitate price discovery and manage risk. If physical delivery obligations threaten the functioning of the exchange, authorities will intervene. They will protect the system, not individual positions. Now let's zoom out and talk about why China did this. Because this is not just about silver. This is about strategic positioning in a world where supply chains are becoming weaponized. China learned a very specific lesson in the 1930s. During that period, China operated on a silver standard. Taxes were collected in silver, contracts were denominated in silver, the monetary system depended on silver. In 1934, the United States passed the Silver Purchase Act, which required the U.S. Treasury to buy large quantities of silver. This drove global silver prices higher. For a country on a silver standard, rising silver prices were destabilizing. Silver flowed out of China toward higher prices elsewhere. The monetary base contracted. Deflation set in. By 1935, China was forced to abandon the silver standard and move to a managed paper currency. The lesson was clear. If your economy depends on a commodity you don't control, other countries can destabilize you by manipulating that commodity. Fast forward 90 years, and China has ensured that lesson is not repeated. By controlling refining and now controlling exports, China has inverted the dynamic. They are no longer vulnerable to external manipulation of a critical material. Instead, they are in a position to influence who has access to that material. This fits into a broader pattern. China has been systematically building control over supply chains for materials deemed strategically important. Rare earths, as I mentioned, graphite for batteries, cobalt processing, lithium refining, gallium and germanium, both of which were placed under export restrictions in 2023. Silver is the latest addition to this list, and it's important because silver is not niche, it's used everywhere. Electronics, energy, defense, medical technology. The geopolitical implication is straightforward. If China can throttle the supply of silver to global markets, they gain leverage over industries that depend on it. Solar panel manufacturing in Europe, semiconductor production in Taiwan, defense electronics in the United States. This is not about starting a trade war. It's about having options. It's about making sure that in any negotiation, China has something the other side needs. Now, what happens in the coming weeks and months? I'm not going to predict silver prices. I don't know if silver goes to $100 per ounce or drops back to $60. What I can tell you is what the historical pattern suggests. Silver tends to move in long periods of stagnation, followed by short periods of extreme volatility. In the 1970s, silver went from roughly $1.50 per ounce to over $50 in less than a decade. Then it collapsed back down. In the 2000s, silver went from around $4 per ounce in 2001 to nearly $50 per ounce in 2011. Then it spent most of the next decade declining. The moves are not linear. They are driven by a combination of industrial demand, investment demand, and speculative momentum. When silver starts moving, it tends to overshoot in both directions. That's the nature of a relatively small market with inelastic supply. A surge in investment demand can push prices much higher than fundamentals would suggest. And when speculative money exits, prices can fall just as quickly. What's different this time is the structural component. Previous silver rallies were driven primarily by monetary concerns or investment flows. This situation has an added layer. Supply chain restrictions imposed by a major refining hub that went into effect today. That introduces a variable that wasn't present in previous cycles. It means that even if investment demand moderates, industrial users may still face tightness. And that tightness doesn't necessarily resolve through higher prices. It might resolve through rationing, through longer lead times, or through substitution where possible. For industries that cannot substitute away from silver, this creates a planning problem starting today. If you're a manufacturer and you can't reliably source a critical input, you have to either build inventory, which ties up capital, or you have to diversify your supply chain, which takes time and increases costs. Either way, your operating environment just became more complex. For investors, the situation is different. If you hold physical silver in allocated storage outside of China, you're not directly affected by export restrictions. Your metal is already where it needs to be, but you are affected by how markets reprice based on changing perceptions of availability. If the market believes physical silver is becoming harder to access, paper prices may rise to reflect that belief. Or they may not, if most trading remains in the paper layer and physical tightness doesn't transmit to futures prices. This is the disconnect I mentioned earlier. Paper markets can trade freely even when physical markets are constrained. The two layers can decouple for extended periods. Eventually, they tend to reconverge, but the timing is unpredictable. And during the period of dislocation, strange things happen. Premiums spike, delivery delays extend, smaller buyers get priced out, and the people who understand the difference between paper exposure and physical possession have an advantage. Let me be very clear about one thing. I am not telling you to buy silver. I am not telling you to sell silver. I'm telling you that as of today, the structure of the silver market is operating under rules that didn't exist yesterday. And when structures change, participants need to reassess their assumptions about how markets function. If you believe that silver markets will quickly adapt and that the new restrictions won't significantly impact global flows, then this may not concern you. If you believe that we are entering a period where strategic materials are increasingly subject to geopolitical control, then you might want to pay close attention to how this unfolds over the coming weeks. The broader implication is about resource security. Energy security has been a recognized strategic priority for decades. Countries maintain oil reserves. They diversify supply sources. They invest in alternatives. Material security is becoming equally important. You can't build electric vehicles without lithium, cobalt, nickel, and copper. You can't build solar panels without silver and polysilicon. You can't build advanced semiconductors without dozens of specialized materials, many of which are processed in concentrated geographic locations. China recognized this before most Western governments did. They spent the past 2 decades building dominant positions in processing and refining for materials they identified as critical, not necessarily mining them, but processing them. Because processing is where value is added and where leverage exists. You can mine lithium in Australia, but if it gets processed in China, China still has influence over that supply chain. Today's silver export restrictions are part of this larger strategy. They signal to the world that China is willing to use its position in critical supply chains as a tool of statecraft. And that signal matters because it changes how companies and governments think about supply chain risk. It accelerates the push for diversification. It increases the cost of doing business. And it creates opportunities for countries that can develop alternative processing capacity. Australia, Canada, and the United States are all investing in critical mineral processing. But building that infrastructure takes years. In the meantime, the existing infrastructure is concentrated. And concentration creates vulnerability. So where does this leave us? The new rules took effect at midnight. We don't yet know how aggressively they'll be enforced. We don't know how many licenses will be granted or how long the approval process will take. We don't know whether this is a temporary measure or a permanent shift in policy. What we do know is that the market has been reacting for weeks. The Shanghai premium, the surge in Chinese imports over the past quarter, the rising premiums on physical silver in Western markets. These are signals, not predictions, but signals. They suggest that participants with access to information were positioning for a tighter physical market. Whether that tightness materializes in a way that disrupts industrial supply chains and how long it lasts is now the question everyone is watching. I'll continue to monitor this situation. I'll report on what is observable and verifiable, and I'll avoid speculation about where prices are heading. Because the interesting story here is not about prices. It's about how markets adapt when the rules change. It's about who has leverage and who doesn't. And it's about what happens when a material that the world depends on becomes subject to political discretion. Today marks the beginning of that new reality. How it plays out will depend on how Beijing implements the policy, how global supply chains adapt, and whether alternative refining capacity can be developed quickly enough to reduce dependence on Chinese processing. If you found this analysis useful, consider subscribing. The next briefing will cover lithium processing bottlenecks and what is happening in the battery supply chain as similar dynamics begin to emerge. Until then, stay informed. And remember that in markets, as in geopolitics, control over critical resources is often more valuable than ownership.